Welcome to The Explainer. Today, we're diving into an incredibly high-stakes financial maneuver that's unfolding right now deep within the U.S. Treasury. I know, debt buybacks sound like some complex Wall Street plumbing, but trust me, this has massive implications for the broader economy, the central bank, and ultimately, your own wallet. We're going to unpack exactly what the Treasury's doing, why they're doing it, and the very real risks involved. Let's get right into it. To really grasp the immense pressure driving this whole strategy, we have to talk about one staggering number: $963 billion. That is the amount the federal government spent on net interest payments in just the first 10 months of fiscal year 2026 alone. I mean, think about that. Debt payments now eat up roughly 15% of all fiscal spending. The sheer scale of this burden is literally forcing the government's hand in ways we rarely ever see. So this brings us to the central mystery of today's explainer. How exactly is the Treasury trying to artificially lower this massive interest bill? Well, here's our roadmap. We'll hit the bond market sell-off, how buybacks work, the short-term switch, risks to taxpayers, and finally, Treasury versus the Fed.
Section 1. The bond market sell-off. To understand why the Treasury had to act so fast, we really need to look at what pushed yields higher in the first place.
The main catalyst here, global instability. When the Iran war broke out, investors panicked, and that triggered a massive sell-off in the Treasury market. Bond prices dropped, and as a direct result, yields shot up. The 10-year Treasury yield rose by nearly 70 basis points, topping out at a highly uncomfortable 4.74%. And since that 10-year yield is basically the benchmark for borrowing costs across the entire economy, 30-year mortgage rates surged right along with it, hitting around 6.75%.
Now, this sell-off wasn't just some abstract Wall Street noise. It created a very real, very immediate affordability crisis. Rapidly rising Treasury yields threaten everyday consumer affordability. They complicate borrowing for corporations trying to expand, and, going right back to that nearly $1 trillion figure, they make it exponentially more expensive for the government to finance its own rapidly growing debt. The Treasury absolutely had to step in.
Section 2. How buybacks actually work. Enter Treasury Secretary Scott Bessent. He stepped in with a truly historic effort, announcing the department would increase buybacks of long-term Treasury debt, raising the maximum it'll buy from $2 billion to at least $4 billion.
But before we get into the controversial parts of this plan, let's quickly cover the official stated purpose of these buybacks. The Treasury formally claims this is all about market liquidity. Just between us, to strip away the jargon, market liquidity simply means ensuring there are enough buyers and sellers in a given market to establish reliable prices. So the stated goal is just to improve that liquidity for certain less traded debt instruments.
Okay, so mechanically, how does this actually work? It's a pretty straightforward 1, 2, 3 process. First, the Treasury steps in to buy back longer-term maturities, specifically bonds with 10 to 30 years left, pulling these older, less popular securities completely off the market. Second, by taking these bonds off the hands of financial institutions, it frees up a ton of cash on their balance sheets. And third, those institutions then use that freed-up capital to buy newer, more liquid issues, which naturally puts downward pressure on interest rates. Just to put into perspective how bad this liquidity problem had gotten for older debt, consider a 30-year Treasury bond issued back in May 2020. Even though it still has 24 years left until maturity, it was recently trading at a massive discount, roughly 45 cents on the dollar. It's literally like a clearance aisle for government debt. Buyers for these older bonds had become incredibly scarce, which perfectly illustrates why the Treasury felt so pressured to clear them out. Section 3, the short-term debt switch. Now, here is where this intervention stops being routine market maintenance and becomes incredibly controversial. We need to look at the hidden mechanics of how these buybacks are actually being funded. Because, unlike the Federal Reserve, the Treasury can't just magically print money to buy these bonds. They have to fund the purchases by issuing new debt.
And that brings us right to the core of the strategy. The standard expectation in the market is that if the Treasury buys back long-term bonds, they're going to fund it by issuing new long-term bonds, right? Makes sense. But that is not what's happening. Instead, Secretary Bessent's strategy replaces those retired long-term bonds with short-term bills. By intentionally shifting the type of debt they issue, they are actively manipulating the yield curve to tamp down long-term rates.
Let's reframe this into a normal household budget for a second, because it makes the risk much easier to understand. Imagine a family decides to trade in their safe, predictable 30-year fixed-rate mortgage for a much riskier adjustable-rate mortgage. They do it because, hey, the payments are cheaper today. But by moving to short-term financing,
They are exposing themselves to immense financial pain if interest rates spike down the road. That is exactly what the Treasury is doing right now on a national scale.
The rule-breaking nature of this move is pretty wild. The Treasury Borrowing Advisory Committee, which is an apolitical group of market experts, highly recommends that short-term key bills make up no more than a strict 20% ceiling of outstanding Treasury debt. But under Bessent, the Treasury has pushed actual levels to 22.2%. They are leaning heavily on short-term debt, completely at odds with their own advisory committee's safety recommendations.
Section 4, Risks to Taxpayers. So the crucial point here is that while this maneuver successfully halted the bond market sell-off and artificially lowered yields for the moment, it fundamentally shifts enormous economic risks directly onto the shoulders of everyday taxpayers. We're talking about $32.2 trillion in public debt. By tipping the federal debt profile more towards short-term maturities, the cost to finance that staggering $32.2 trillion becomes dangerously sensitive to any future interest rate hikes by the Federal Reserve. The potential domino effects here are incredibly concerning, and they're moving fast. First off, if the Fed is forced to raise interest rates, government interest expenses will rapidly increase, which would blow up the deficit even further. Second, by intentionally keeping long-term rates low, the Treasury is boosting economic activity, which actually supercharges the risk of sticking inflation. And third, we've already seen immediate market reactions. Following Bessent's buyback, the dollar fell by nearly 0.8% against a basket of currencies, and that threatens to increase inflation right here at home by making imported goods much more expensive.
Section 5. Treasury versus the Fed. And this brings us to the climax of our explainer. Because what we're really watching unfold here is a massive institutional standoff between the fiscal goals of the Treasury Department and the monetary policy of the independent Federal Reserve.
The political backdrop right now is just incredibly intense. The Congressional Budget Office projects the federal budget deficit is on track to hit $2.1 trillion this year. At the exact same time, President Trump has demanded that the Fed cut interest rates to lower the burden of financing that debt, even while the administration is simultaneously pushing policies that add to the national debt.
It's essentially a squeeze play on the central bank. Joseph Brasulis, chief economist at RSMUS, captured this perfectly. He notes, "We're slowly moving to the point where the logic of populism is going to insist that the central bank support fiscal objectives. The prevailing fear in the market is that the independent Federal Reserve is being cornered into abandoning its core mandate just to help the government finance its historic spending."
And all of this leaves Fed Chairman Kevin Warsh in a virtually impossible dilemma. Inflation has been stuck above the Fed's 2% target for more than 5 years now. Warsh desperately needs clear signals from the bond market to figure out how to set policy, but those natural signals are being actively clouded by the Treasury manipulating the yield curve. It creates this intense long-term pressure on Warsh to align Fed policy with what the Treasury wants rather than what the economy actually needs.
There's also a pretty rich layer of irony in all of this. Back in 2024, Scott Bessent actually criticized his predecessor, Janet Yellen, for adopting this exact same policy of issuing more T-bills. He accused her of putting her thumb on the scale of markets to hide the costs of overspending. Funny how things change, right? Meanwhile, Chairman Warsh has historically attacked past Fed bond purchases for keeping yields artificially down, arguing it just opens the door for overspending by Congress and the administration. The roles might have shifted slightly, but that fundamental tension, it is still very much there.
And this conflict is coming to a head literally right now. All eyes in the financial world are turning toward Wyoming, where Chairman Warsh will have an opportunity to publicly address these exact issues and the Fed's increasingly strained relationship with the Treasury at the high-stakes annual gathering of central bankers in Jackson Hole next week.
So it leaves us with one overarching question to consider. The Treasury has successfully used a clever, albeit controversial, short-term fix to calm the debt market today. But by shifting our national debt onto a riskier, adjustable rate and putting unprecedented pressure on the Federal Reserve, will this ultimately lead to a massive long-term economic policy error? We'll absolutely be watching closely as the standoff between the Treasury and the Fed continues. Thanks so much for joining us for this explainer, and we'll catch you next time.